Welcome to Big Business This Week. I'm JD Durkin here on the trading floor of the one and only NYSE. The U.S. Federal Reserve holding rates steady this week as markets eye inflation, jobs data, and of course, lots of political pressure from the president. Big tech earnings also in focus. Apple, Microsoft, Amazon, and Meta all taking center stage, while the timeline for rate cuts remains a little bit more uncertain after a big GDP surprise to the upside. Join us this week to break it all down and much more. A good friend of ours, Madison Mills, senior markets reporter at Axios. Great to have you here, my friend. Thanks for joining us this week.
Thank you for having me, JD. So excited.
So before we get into kind of the nuances of the week that has been and a glimpse of what's to come, what do you make of the broader market performance we've seen as of late? We know uncertainty has been the word of the moment, but despite that, markets have been climbing quite the wall of worry. What have you seen?
Stocks just keep getting higher, right? It seems like nothing can stop this bull market at this point in time. We've continued to see stocks rallying even today with Microsoft entering the $4 trillion club right alongside Nvidia. So there's just so much euphoria, especially around those big tech names, that for most of the investors who I talk with, even if they are concerned about something like, pesky little valuations, for example, they're having trouble worrying too much about that when if you just invest in big tech, you can beat the broader index by as much as 30%. And I think we're really seeing that tech rally defining this bull market, and it's going to continue to be difficult for that to change. It's going to be hard for there to be a catalyst that changes the big tech outperformance that we've seen. And as you smartly bring up, we've got more big tech earnings this week that will either cement or maybe add some more nuance to that tech narrative too.
Yeah, Madison, I know a big part of your reporting, you're always talking with really smart sources all over Wall Street. It's really central to a lot of the videos and social media content and the core of your reporting. What are your sources on Wall Street telling you about how they are approaching this environment where, despite the uncertainty, despite the wall of worry, equities, for the most part, they still continue to find that next leg up, largely on the back of a lot of these so-called Magnificent Seven big tech stocks?
I feel like there are two big camps of folks that I talk to. One camp are the bulls, who say that there's no such thing as a pain trade when the market's going higher, that the pain trade is only when the market's going down. So they're perfectly fine with concentration and a couple of names with valuations soaring, and they are just happy to kind of ride this gravy train for as long as they can. But then I talked to another group of sources this morning. I was talking to David Kelly at JP Morgan, and he brought up this idea of the tortoise and the hare, and the economy is the tortoise and equities are the hare, and they're kind of outpacing the growth of this economy. And at some point that has to correct, in his view. And he thinks that that's going to happen, especially in these big tech names where we have seen valuations get out of control, according to some people. And so the kind of investment thesis around that is making sure that you're diversified and you're not over allocated to big tech, because in David's view, that basket of stocks is due for a correction at some point. The question is what would possibly cause that in this euphoric environment.
Yeah, you mentioned Microsoft earlier. I mean, I remember once upon a time, you and I are both old enough to remember when we were approaching the first ever $1 trillion companies here on Wall Street. Somehow now we are at the $4 trillion club. What do you make of that remarkable kind of push for a handful of companies in very exclusive territory, reaching $4 trillion in market cap?
For Nvidia and Microsoft, they're such defining companies of the AI industrial revolution. If you follow Dan Ives at Wedbush, and he would say that these two names really define that next AI bull market that he thinks will last anywhere from 12 to 18 more months. But it is, to your point, JD, just fascinating to see. I mean, every member of the Mag 7X Tesla is in the top slate of spots to enter the $4 trillion market cap club. You've got Apple right on the tails of Microsoft at, I think, $3.5 trillion in valuation. And Apple has struggled year to date. We're going to hear from them on Thursday evening here. So it'll be interesting to see if they can kind of convince investors of their AI narrative to be able to get some of those gains that seem to be pushing companies into the $4 trillion club. It seems like to enter into that exclusive group, you've got to prove a clear AI story. And obviously Microsoft has been able to do that. And same with Nvidia, of course, as well.
I want to get your perspective on this week's Fed meeting. Maybe not a big surprise that the FOMC voting members, Maddie, chose to not really do very much with interest rates, but we've got this new emerging narrative, this new conversation, a couple of dual dissenters now for the first time in a long time. What did you learn out of the Federal Open Markets Committee down in Washington this week? And how do you think that kind of charts the course ahead with regards to investors who are eagerly anticipating a rate cut at some point?
It's funny with these Fed meetings. I'm sure you feel the same way in your reporting. You continue to monitor them for any sign of a word change or any tone shift that might give us a clue into their thinking. And then it's always more of the same. Like, yeah, when the data changes, we will change. But until we get to that 2% target, we're not going to change things. And it felt like more of that same from this meeting. But you're right to point out that the dissent was new, and Powell has really built his career as Fed chair as someone who builds consensus amongst the Fed. This is new for us to see this level of dissent. But it is interesting in my conversations with economists, I've found them dissenting on what the Fed should do, on the health of this economy, on whether or not, even with yesterday's GDP numbers, does that indicate a really strong economy, or is it a sign of, a lack of imports fueling a higher number? So it kind of made sense to me to have dissent on the Fed when little old me is talking to economists who are dissenting with each other all the time. So it's not too surprising to me to see that playing out. And of course, obviously, the elephant in the room is the kind of political ramifications of that dissent and the fact that the dissenters are potentially interested in taking on that top Fed chair spot themselves someday. But I think just points to kind of the muddied economy that we're in right now and how difficult it is to suss out the health of this economy.
Maddie, this is the first time you and I have spoken in a while. There's so much that has happened that I would love to catch up with you about, but specifically here on the Fed, what did you make last week of the president's visit? This kind of very surreal moment of the president in a hard hat, Jay Powell in a hard hat, Senator Tim Scott was standing there. They're kind of publicly disagreeing about the cost of the Fed overhaul and renovation. It is in and of itself so strange to have a sitting president say, I'm going to visit the U.S. Federal Reserve, of all places. But strange and surreal is sort of the new name of the game. What did you make out of what we saw out of Washington that day?
Well, the tension between the president and the Fed chair, that's kind of nothing new in a way. We've seen this movie before when it comes to presidents pushing for lower interest rates, and not too surprising that we've got, a real estate mogul in the White House who wants lower interest rates. But it is interesting to see, in my view and in my conversations, how Wall Street has responded to that tension this time around. Does feel a bit unique to me. I was able to speak with Mohamed El-Erian, who used to be the CEO of PIMCO. He's kind of a bond legend. And he was the first to tell me that he thought that Powell should resign to protect the independence of the Federal Reserve. And that's where you see this really interesting conversation happening on Wall Street about the consensus seems to be the Fed needs to be independent, because if not, then you have, policy running rampant in terms of fueling inflation. Like, what would stop the White House from issuing stimulus checks all the time without an independent Federal Reserve? But there's a differentiation on how to achieve Fed independence that I'm picking up from folks. And some are arguing that Powell's almost at the end of his term anyway. He should step down in order to make sure that the administration doesn't sort of attack the broader body of the Fed, that they keep it just to Powell. My conversation with him was the first time that I had heard that argument, and that was surrounding that meeting with the president and Fed Chair Powell at the Federal Reserve building. So again, just points to the dissent building across Wall Street right now.
Yeah, there's no doubt about it. And that was a great bit of news-making item on your part from Mohamed El-Erian, because all of us that love this stuff in the financial markets, obviously we all know Mohamed, and that was a great bit of reporting on your part. It kind of seems as if we priced out a rate cut now. If you follow the CME Group FedWatch tool, we had gone into this week expecting maybe a small cut of 25 basis points in September, maybe another one in December. Now it kind of seems like we're pushing that timeline. We've also seen this story play itself out before, but what do you make of now the market participants and their expectations, maybe after the stronger than expected GDP print in some ways, to sort of push out that timeline a little bit further into the future for an eventual cut?
Well, adding fuel to the, later cut fire is the idea that the inflation data hasn't even fully taken into account the tariff pressures just yet. And we keep saying, this CPI print doesn't count. The next one will, the next one will. But Everyone's telling me that finally in September, those are going to be the data points that finally actually matter and tell us what the status is of inflation. And I've been really trying to work with as many folks as I can to like look at the data, look at the import data, who's paying what, to get a sense of when we will finally have clarity about how tariffs are impacting inflation. And it overwhelmingly, I'm hearing that September is finally when we'll get that clarity. So come the fall, if we do start to have a little bit of a hotter inflation picture, then why would the Federal Reserve cut interest rates at that time is kind of the key question. And that's something that obviously the market has been contending with in terms of how they're pricing Fed rate cuts to come. And, you know, it's such an important moment of time between now and that next Fed meeting. I think we have 2 jobs reports, 2 inflation prints, so much additional economic data that will give them hopefully an even clearer picture of how policy from the White House is sort of funneling through the economy so that they can make those decisions. But they've also been so clear that they don't want to front load the impact of tariff policy. They just want to wait and see it in the data. So maybe that September meeting, maybe it'll finally be the one where we get something new and some interesting takes from those members of the Fed and their commentary.
Yeah, Maddie, you know better than I do. The Fed, Jay Powell, his colleagues, they like to say we are data dependent. We have lots of data. We pore over it every week, every month. What are those maybe more important pieces of data for the FOMC to stay dependent on, to really give them that sense of confidence that on the one hand, inflation is trending closer to its goal of 2%, and at the other hand, we want to make sure we do not have this kind of deterioration in the labor market conditions? What are those prints that you most closely follow week to week or month over month?
Well, we've got the jobs report tomorrow, so that's going to be a fun one to monitor in terms of getting a sense of the health of the labor market. I tend to look at the average, the 4-week moving average of initial jobless claims between those jobs prints to get a sense as well of how the labor market's doing. I know the Fed would say it's all about, you know, core PCE, excluding some of those volatile categories like food and energy that can be a little bit more volatile. I personally like to look at a little bit more of the anecdotal data. I feel like this is one of the benefits of us being, you know, incredibly cool young people, JD, is that we can monitor trends on social media and see what the kids are up to, you know? And one of the things I've just been really kind of obsessed with lately is like the explosion of Labubu and like really expensive purchases from younger and lower income consumers. What does that tell us about the economy? Does it mean the consumer is more resilient, or does it mean that younger people are just so sure that they can't afford homes that they have more expendable income? And how is that playing into the economic data, especially when you have wealthier people also contributing so much to consumer spending that may be clouding some of the weakness that could be happening with lower income individuals. So that's kind of my obsession at the moment, is like how the wealth gap and how consumer spending trends might be impacting the broader economic data picture, and whether or not we even have clarity on the economy based on some of that muddiness.
I gotta be honest, my friend, and I'm not just saying this because you generously joined us for the week. I don't know that there's any of my industry colleagues from whom I learn more from because of your videos, because of your content, because you make this information so relatable and accessible to the average investor or person who wants to be smarter on the markets than you. Madison Mills, we have to leave it there. A very busy IPO day here at the stock exchange, as I know you know. Maddie is senior markets reporter at Axios. Madison, thanks for being here this week. Great to have you.
Thank you, JD. Appreciate it.